So the next speaker, and again, I was kind of joking about, when you do these cold calls and you just sort of phone people, I've learned over the years that now with the advent of email, I usually try to soften them up by first sending them an email. So when you look at mobilizing local capital, you quickly understand that Nova Scotia by far is the leader in Canada. They've had this program called Community Economic Development Investment Funds now for over 10 years. Really has done just amazing things in that province, which Chris will tell you about. But certainly when I phoned a couple of people I knew still in the field, they said, oh, you got to get Chris. Chris works for the Nova Scotia government, but he really gets it. He was there. He was one of the key champions within the provincial government to create this program. Knows it inside out. And so I sent Chris an email and said, hey, you don't know me. I'm writing in from the other coast of Canada, or one of the other coasts, I guess I better say. And any chance at all you might be able to make a few minutes for me if I could give you a call, or thinking of doing a conference. So I know Chris is under a lot of pressure these days. He gets a lot of invites to speak. He was kind enough after he and I spoke a couple times to talk to his boss, and somehow managed to wangle to let his boss let him free again, because like I say, I know he gets a lot of speaking engagements. And again, I had to give up some time over the weekend to come and join us. But Chris runs within the Nova Scotia government. He runs most of this program with the Securities Commission. So what I asked Chris if he could do today is sort of give us an overview of this program and how it works. So Chris, I'll hand it over to you. Thanks again.
Thanks, Gordon. It's great to be back in British Columbia again. It's a beautiful place to come, especially this time of year, or I guess any time of year. Going back to Mike's comments, I wasn't sure I could follow the details of the whole evolution and value of money, but maybe over beer later we can debate the merits of the St. Lawrence Seaway, because it's had a lot of negative impacts on Nova Scotia. But in any case,
My father was from Nova Scotia. I'm with you on it.
all right, just so we don't get the debate started now, I'll save it for later. So again, it's great to be here, and I've had the opportunity to speak in a lot of different places around across Canada about what we've done in Nova Scotia. As you can see, some pictures at the top, some coffee beans, and there's a coffee roastery, ethical, and it's fair trade. It's really grown using this, and we'll highlight that. As Peter would recognize, the giant fiddle in the waterfront in Sydney. A farmer's market, again, another example of a CEDIF. And then a wind turbine, because there's been a lot of projects done for renewable energy, primarily on wind, for small wind for community feeding tariff.
And I can't you lift the mic because the people at the very back, I think, are nodding and we can't hear.
We're older than you. Speak up.
What?
Okay.
That's fair. Okay, I'll do my best. Sorry, I'm not used to speaking with a microphone. So if anyone can't hear me anymore, or just loses their interest, just let me know. So again, if you can flip the slide, please. Okay, so again, this will be, I'm trying to get the balance, because I assume most people in the room really don't know anything about CEDIFs at all, probably never heard the acronym before. So the Community Economic Development Investment Fund is something that was originally thought of back in 1993, and someone said, hey, we should do this. It actually got into the budget documents for the province and said we should do this, and then they realized that, we actually can't do this, because we have the Securities Act and the Finance Act, and all these things didn't mesh together. So it just sat on the shelf for 5 years. And then I was tapped or tasked or voluntold to do it. So basically, it was interesting. We got a group together with the Securities Commissioner, Corporate Finance. We had some lawyers from the Dalhousie Law School, and came up with a way to try and figure out, because we had some early iterations around ESOP programs and early iterations around equity tax credit to try and encourage people to invest in the private business. But what we had found was there was a lot of businesses that needed money, and there was lots of people who had money, but the two groups never went to the same room. So there was no real reason, there was no way that people with money would find out about the good ideas, and people with the good ideas couldn't find the money. So it just didn't work out. So we tried to figure out a way that we could bridge that, and do something to get people together talking, so that those people with the good ideas, the people with the money who have previously made money from things, can get together and they can have these kind of conversations, and ideally, then one will fund the other. So again, I love to always have a pretty picture on the slide. That's in Port Hood in Cape Breton, which is probably beautiful there today, and it's very nice warm water there as well. It may not be as warm as the lake, but it is nice warm water. And what they did there, there is a reason why that was shown. It's the Port Hood RV Park. There was a group of people, and Port Hood is in Cape Breton on a very touristy kind of part of the province. The Cabot Trail, very famous drive. So they decided they wanted to do something to capture the thousands and thousands of tourists who were driving by, but they never stopped. So what they decided they wanted to do was they wanted to develop an RV park, and they got together local people. Of course, the Al McGuinness Arena is down the street. Anyone that follows the Flames would know Al McGuinness is from Port Hood. So they got together with the local church who owned a lot of land, and they decided they were going to raise money and develop an RV park. It would be in conjunction with the arena and a number of other things. So I highlight that as it's something that there's nobody in a government office in Halifax could ever come up with the idea that you should build an RV park in Port Hood. But they did it. They raised the money. They built it. It's been running now for about 4 years. It's successful. It makes money. It employs people. It's a great example of the people in that local community identified something that they needed to have done, and they went ahead and did it. So again, going back into the 101, or starting this out, it's all about getting communities to take the money that they already have and reinvest it into themselves rather than sending it all to Toronto. So you can raise capital. It has to be for-profit companies. You can set up as a corporation or a co-op. You can't do a society, you can't be a non-profit, nothing like that. You have to be actually generating revenue. You need to have directors, and to do this, the minimum we set out was $100,000 as a raise and 25 investors to demonstrate a community. So it's not a large amount of money, but if you did it anything smaller than that, the amount of time it takes to do it, it doesn't justify the amount of investment you need to put into it. The average we have from one of these funds is about $500,000. And they are subject to regulation by our Securities Commission, and we have to acknowledge, again, this kind of drifts away from me, over time, the Securities Commission of Nova Scotia has been really a good force to help us to do this and to do it right. And it was really lucky. Again, sometimes it's easier to do things in a smaller place than a larger place. I've dealt with the Securities Commission now for more than 10 years, and by and large, the staff there are the same people that I've been working with for that amount of time. And at the time, the Securities Commission had 12 people. Comparatively speaking, the OSC in Ontario has 1,500 people, about half of whom are lawyers. So if you tried to get anything to your OSC, you just never would. So we're lucky enough that we can do things on a small scale, and when issues happen, we can just leave a phone call, have a meeting, and we can deal with things, and it's much easier to do. One of the very few advantages of a small, less prosperous province. So as we look at this is a slide that I stole from someone else, and I put the credit on the bottom. But just to give some idea as to where CEDAs fit on a spectrum, from the charity on one side, the pure commercial enterprise, and the CEDAs are sitting, and a lot of the CEDAs are set up as co-ops. So they share a lot of similarities to a co-op structure. And it's people making the investment. The CEDAs themselves are very different. As I show some examples here, there's some that are very close to the pure commercial enterprise that are basically using this tool as a way to capitalize themselves to move forward in the private business, and others are much more about their community. So for instance, the Justice Coffee Roasters or the Port Hood RV Park, they like to see the business operate. It has to be sustainable, it has to generate a profit, but their main focus is making sure it's on the community, it's being done in a way that benefits the whole community. I think we can leave that one alone. So going in, there's a lot of details on this, and I'm trying to find the right balance between giving you enough details without smothering you with just too many details and you'll all gloss over. So again, The background shows 93 was when it was first talked about. It actually came out in 99 and 2000. In order to do this, we had to create a new exemption under Securities Act in order to be allowed to do a public offering. These CDIFs are a restricted public offering in Nova Scotia, so they have the same sort of, they sound somewhat intimidating if you're doing a public offering, but generally speaking, we create what they call the simplified offering document. So the simplified offering document is the template document that a community needs to complete that'll outline what it is you're going to do, who's involved, what kind of conflicts are there, what can the investors expect to see. One of the early, I guess, wins we have is that we had pre-approved a holding for an RSP, so if you invest into your community fund, you're allowed to hold it in your self-directed RSP. So the province provides a tax credit. It was originally 30%, and it went to 35%. No one ever asked for that change, just the government one day decided they were going to change it from 30 to 35%. So there's a 35% tax credit. In addition to that, you can also put it into your RSP so you can stack the benefits. So if you happen to be in the middle tax bracket, you get about 42% back on your RSP, plus 35% from your provincial tax credit, so you can see you quickly take the risk out of most of your investments. As I said, many use co-op. Probably about a quarter of them would be co-op and 3/4 would be corporate, which doesn't sound to be that huge, except in Nova Scotia there's about 400 co-ops and about 25,000 corporations. So to have 1 in 4 for co-ops, and this is a very high ratio. The rollover credits is something else that we brought about in 2006. When we originally had these, we had a provincial guarantee on them as well. So an investor putting their money in for 4 years, there was a guarantee of 20%. And that basically meant if the whole fund lost all its money, the government would cut you a check for 20 cents on the dollar. It wasn't a very, most people putting the funds out weren't worried about the losses. They were more looking for ways to market. And the provincial government was uncomfortable because of the accounting treatment that the guarantee had, that all the funds, that 20% would have to be set up as a potential liability. So what we did was we removed the guarantee and replaced it with a rollover provision. So that allowed for funds. We didn't want funds to raise money, put it to work, and then close. And then start a new fund, raise money, and close. We wanted to get them to be more sustainable. So after 5 years, you can get a second tax credit, and then after 10 years, a third tax credit. So ideally, for a community such as what you'd be doing here, you'd look to raise your money, you'd invest it, you continually go back to market, raise more money, so that over a period of time, if people like what you were doing, 5 years from now, the opportunity came up, you had the choice to either cash out your shares or leave them in for another 5 years and get a subsequent tax credit. So those have worked really well, and certainly Peter can talk about his experience as well with those. But for most people that have done this, if they've done the investment, the great majority will tend to stay in. We have 9 funds that are currently paying dividends to their investors, which is really nice to see. When these were first talked about, there was a lot of people that thinking this was a donation or some sort of scheme, and these are not a donation scheme. People are investing with an expectation to see a return on their money. So the dividends that the funds do pay, they have to be called non-liquidating dividends, which means you have to actually earn money. You can't simply pay back people the money that they previously invested. We've had 3 funds that failed. And there's 2 more that are sort of on their last legs that aren't going to, they're not going to provide a good return to their investors. But when you look at the nature of how many funds we've done, which we're over 50 funds, closing in on 60, to have 3 and eventually it'll be 5, it'll still be a 90% survival success rate. So overall, it's been very good. So again, this is another picture, and as I get the microphone, I can hear it louder. So this is the Marigold. It's an old Empire Theatres that was in Truro, which is a small town outside of Halifax. The community, again, got together and they looked at it and said, well, they were going to bulldoze this and make another parking lot, and I don't know why, there's a lot of parking lots in Truro already, but they decided they were going to try and save this old Triplex Theatre, and they wanted to turn it into a community center, an arts and cultural type center. So they found a few gentlemen in the town who had sufficient means they went and bought the building for them. It was about $300,000 or something along those lines, and said, if you raise the money, we'll transfer the ownership over to you, and you can carry on. So that gave them a window to raise their funds. They decided they were going to go out and they raised a good group of people that knew everyone, including Diane Kellerman, that unfortunately can't come here today, but and really sort of developed sort of a war room mentality. They got in there and made sure that everyone would contact somebody else in the community. And within, I think it was in less than 90 days, they've raised about $900,000. And this is from a very, very, very small community. It's from the analysis you said yesterday, they don't have a Costco in Truro, so it is a rural community. So again, going back to the basics, that's another example of one that's really interesting. It's still operating now, and it runs sort of events that wouldn't normally happen in that size community. So they bring in small touring artists, some cultural events and things like that. They also run a small sort of local museum. They have some offices in front that help with some cash flow. But again, going to the basics of why the province wanted to be involved in this, that there's an awful lot of small businesses that I assume the BC financing spectrum is going to consist of what we have in Nova Scotia. You'll have your government lenders from the province. You'll also have your WD, which is our other side of ACOA. There's a lot of sort of FBPB and BBC and all these other entities along with the banks. So there's a lot of different debt providers, but there's not a lot of equity providers. There's not a lot of investors that are going to go in and share the benefits and share the risks, and also, so the businesses, you'll see a lot of them, their balance sheet looks really skewed. They've borrowed a lot of money, and generally speaking, that debt, again, going back to the idea of the compound interest, when the small businesses have these debts, it's really difficult. It doesn't have much flexibility because they need to service that debt. If they don't service the debt, they're dead. So it's really key to minimize that debt. So we wanted to also look at this from a sort of policy standpoint from the province, and we have provide an opportunity for people who want to do something, people who maybe have the financial means to make some investments. So we want to give that opportunity to invest at home. And then the capital retention, which is tied to the others, of course, is, again, Nova Scotia is a small place. There's a lot of things that Mike was talking about that resonated with me. We have about 920,000 people in Nova Scotia, and that number is not going up. And there's nobody that I've ever seen do a presentation that suggests our population is going to go up. It's, if anything, going to come slightly down. So we need to maintain money in Nova Scotia. We put about $600 million a year into RSPs every year, and by and large, rough estimate is about 98% of that leaves Nova Scotia and never comes back. So if we can find a way to retain a small slither of that, which then can be used to invest in our businesses, it will help with all the other things that Mike had talked about and alluded to, that it will help jobs and keep people home. It will help with all the other facilities that we need. So going back, I mentioned Just Us Coffee. They do make great coffee. I don't think it's available here, but it was a couple of professors at Payne University that wanted to start a small sort of coffee roastery. They grew it out from there. They came in very soon afterwards. They came in with the idea of coming in to do a seat for the Just Us Coffee. And they've used that now. They've gone back out. I think they've had 7 offerings. So basically, when a group wants to do a seat of offering, they'll come to myself, and then eventually to the Securities Commission. They'll get their letter of non-objection, they'll get equity tax credit, then they can go out and they can sell their shares. So they raise the money, they take that money and they invest it into the roastery. From there, they go back the next year and say, hey, this worked really well. We made a little bit of money, people are really kind of keen about this, let's go back and raise a bit more money. So they've done that, and now they're in a very enviable position that in the fall, people now call them and say, are you guys going to do an offering this year? We'd like to invest. So they really don't have to do much in the way of going out and selling it. People really like what they're doing. They've expanded from coffee into cocoa and tea and sugar and all kinds of other related things like that. So it's really interesting, interesting small business that's grown now. They've got, I don't know, 65 or 70 people working for them now in a series of cafes around Nova Scotia. So it's pretty cool. As I said earlier, there's 60 active CDs in Nova Scotia. That number will continue to increase every year. And we've had $63 million. And again, that's It depends on where your perspective is. If we were rolling through Calgary and said $63 million, that might be somebody's paycheck last year. But in Nova Scotia, that's a pretty significant amount of money. When we've had more than 6,000 individual investors, and again, with a province of 900,000 people, you cut that down to those people who are actually investment age, and you'll see that it's a huge number from where we started. The tax credits themselves, the financial incentives are a huge driving force. There's also a lot of people are investing for the reasons that they want to make a difference in the community. People who have been successful, they want to give something back. They don't necessarily want to give a donation. They want to give something where they can invest, they can see a return, but they can also have an impact and help some smaller companies to move forward. I think I mentioned too that the financing gap where CDIF sort of works, the sweet spot is $100,000 to $1 million financing range. And Peter will talk about in his fund that's certainly well past $1 million now, but that's kind of the area. If you're looking at less than 100,000, it would be too cumbersome a tool and too difficult to do. And if you're looking to raise more than $1 million in one offering, that also becomes a bit more difficult. But to raise $1 million a year and then go back out, you can raise it from the same sort of constituents is something that works very well. I alluded to and mentioned here again the community feed-in tariff. That was something the government came up with. The community feed-in tariff was trying to encourage community-based ownership of renewable energy. So there's a COMFIT program through Nova Scotia Power. So I knew that was going to happen to somebody. Let's listen to Gordon's call. In any case, so the community feed-in tariff was really good because it encourages people to invest in community wind projects, run a river, tide, all of them. And Nova Scotia Power is mandated to purchase that for a preferred price. So this makes it much easier to finance these kind of projects, and they've been really good. And I think there's been 100 megawatts have come forward with that, which is about $2.5 to $3 million per megawatt, and that ends up being a big number. So again, as we come through the last bullet on here, talking about different ways that CDIFs can invest, we use the term blind pool. And a blind pool is basically where you have a community that knows that it wants to do something, it wants to raise money, but it really doesn't know where that investment is going to go. So for instance, if Christina Lake wanted to get together, they wanted to form a fund, and they wanted to raise some money, but they don't know where the businesses are going to be invested. You need to, the blind pool will then allow you to basically take that money and invest it according to what you say you're going to do. And it's a different model than what you'll see most places. You typically will have to outline exactly where the money is going and invest in a particular business. But the blind pool gives a lot of flexibility, being able to, as long as you have the right people around the table, it gives you a lot of flexibility as to what you're going to do with the funds. So just to give some sort of perspective of the kind of things we do here, and you can see New Dawn Innovation on there as well. So these were the ones that closed just very recently. So Antigonish, again, is a small little town that has come back forth for a number of different investments. The Black Business Community Investment Fund Limited. It's interesting because, again, when you're doing a CDIF offering, you have to define who your community is. And in most instances, the community is going to be a geographic community, Christina Lake or this particular catchment area. But the Black Business Fund actually invests, they define the community to be a community of interest, being the Black community in Nova Scotia. So the Black-owned businesses are those that significantly employ people of Black heritage and descent. And they've been raising small amounts of money now for 6 or 7 years now. They've invested into a number of different businesses, for a rock company and a construction company and a lot of different things. So it's really interesting to see how that translated into what's out there now. The Celtic Current is another one of these small wind producers, as is the Windfield below it. Farmworks Investment Co-op Limited, Linda Best and her group that's trying to raise money to reinvest, to protect agricultural land. It's probably similar here as well in the Annapolis Valley, Nova Scotia, we're the best sort of growing area, where we have a small winery compared to what you have in BC. The best land is also getting a lot of pressure for residential development of the developments. They're trying to maintain the farmland as working farmland. Margaret Community Fund, that's an interesting one as well. They've invested into a grocery store, Co-op grocery store, and it's another sort of story from having done this for a long time. Many years ago, in a small community called The Deck, it's maybe 600 people. It's a very small community. They were going to lose their grocery store, and they were about an hour in either direction to get to the Sobeys and the Loblaws type stores. So there was nothing close by. The community decided they wanted to raise some money, and their local CA that knows everybody's income tax and knows who can invest, and the local lawyers all got together, and they said, well, let's figure out a way to do this. So they decided they wanted to raise some money, and they had a target of $630,000. And so they put it out to the community, and in 6 days, they raised $880,000. So they actually had to prorate the investment and send some of the money back because they had raised too much. So it's an interesting, if you give people the opportunity to invest something local, they very much will like it. And it's been a good investment for them. They pay an annual dividend of 3.9%, and the investors got their tax credit. The grocery store is flourishing, and it's a good win-win story. New Dawn, I'll leave that for Peter. Watts is another one of the wind energy. Waikagama is another one of the retail stores. And the last one, Wind for All Communities. It's interesting because they've, I guess, gone the professionalization of the marketing and sales for wind for all communities. They hit their max this year, another $3 million. And they partnered with Asante Financial to basically do all their sales for them. And so they've accessed a whole new sort of way of raising capital, which you see, I'm not sure, going back to earlier comments, I'm not 100% sure whether it's good or bad, but it's interesting to see what's going on. That's just a slide trying to give a sort of a quick snapshot of the money, so that the numbers were basically each year how much was raised, and I just kind of put colored on there to kind of see the sort of, it started out the first couple of years around $1 million, and then we sat for 4 years in the 2.5. We had an aberration year that we raised $6 million, then we were back on the same sort of 4 to 5, and then the last 3 years where we've had the ComFit program committed, it's really increased the numbers. So you can see that the numbers are certainly starting to get larger. I think when we originally set up this program, my boss at the time, who has since retired, thought it would be a grand thing if we could ever raise $5 million under this. So we've certainly exceeded that number. Here's another wind turbine, and for one thing you have to say about wind turbines, everyone has an opinion. Some people love them, some people hate them. Some think they're basically an ATM machine, they spit money out. Others think they're a light on the skyline. I don't really have an opinion, but it makes for a nice picture. So, so we have the investors again, the tax credit of 35%, and just it is a tax credit, it's not a tax deduction. If you ever have a choice, take the tax credit, it's much better. So it gives you a 35% credit, so if you invested the full maximum amount of $50,000 per person per year, you get $17,500 back on your tax return. It doesn't matter whether you make $10,000 or $10 million, it's the same number. The rollovers I talked about before, and the other one we call here is the adjusted cost base. If we have any accountants in the room, or anyone that is interested in that, the adjusted cost base basically means the tax credit doesn't impact your cost base. So even though your cash cost would have been $32,500, your carrying value is $50,000. So you're taxed on your capital gains only after the $50,000, or if the whole thing goes the other way, you'd have the whole $50,000 as your capital loss. So you can carry it back for 3 years to use up the tax credit against your income, or you can carry it forward for 7. Almost entirely, most of the investors use the credit in the year in which they make the investment. ComFit, again, Community Feedin Tariff, was part of the Renewable Electricity Plan. and it shows the eligible groups, and where it really makes a difference on this when the Micmac Bound Councils and municipalities and other nonprofits can use it. But when it was written and they specifically stated that CETUS could use this with 51%, it really drove enterprising individuals to set up their structures so they could take advantage of the CETUS, so they could raise the money and then move forward to generate community-based power. I think I'll just run past that. Time's probably getting pretty close. So again, the Securities Commission, they are regulated by our Securities Commission in Nova Scotia. They have been great to deal with. They have very stringent rules, and as long as you play by them, everyone gets along fine. So if you don't, then you get a cease trade order, and it looks really bad, and everyone freaks out and panics, and anyway. Then you file your paperwork, and everybody's happy again.
Next Tuesday.
Next Tuesday. Oh,
I know that day.
So again, there's obviously financial requirements when you're using other people's money. So you have to submit your financial statements, and those have to be audited and reviewed. And you basically then just need to make sure that the other requirements of the Securities Commission. So after you close an offering, you have to send a list of who the investors are, and including their SIN number and their address, so that we can send out the tax credit slips. Otherwise, they don't get their tax credits. So again, having done presentations around the province and other places as well, there's a lot of sort of lessons learned. And I guess lessons learned is to get the microphone higher up more often. But again, there's a lot of business leadership. No matter what you're trying to do, you really need to have this approach of a business. As much as you want to have this as a community-based project, it always needs to make sure that you're generating enough revenue to keep the lights on. Even if you have the world's best idea, if you can't make it to the point where it's sustainable, it's just going to be a memory. So you need, in the creation on the requirements of what you have to do, there is quite a regime you have to follow, and Peter will give you more details from his experience about what you need to do. It's been running long enough now that there's a lot of expertise out there, and it's reasonably well laid out and straightforward as to what you have to do. As I've heard from others, expect the unexpected. Weird things happen when you're developing these documents. People do things like change jobs, they move, sometimes they die. And so you can have things like the 6 directors necessary, and when somebody isn't there anymore, then the whole thing goes on pause. So everything takes longer than you expect, everything costs more than you expect. Successes and failures, I did quickly go over. We did have a couple that failed. One of the earlier ones, we had something called Production Schoolhouse, and basically they were raising money to put an IT training center in rural Nova Scotia, and they raised their money, they opened the doors with, I don't know, 450,000 or something along those lines, and they had a deal with HRD or HRSDC or whatever the acronym for the Federal Government Training Center was, and they had a deal with a big computer company in California. And it was either the same day or the day after they opened the doors, the federal government changed policy and said that they were no longer paying for any of these training courses. And the company that they were getting, Silicon Graphics or whatever, that they were sending all of their hardware in, that company then was acquired by another company. And so all of a sudden they got to a situation, they opened the doors and they were good, and their cash flow said we're good to run for 2 or 3 months, but then all of a sudden all of their clients dried up, and then their supplier dried up. So it wasn't because anybody walked away in the middle of the night with a bag of money. It was just a matter of they tried their best to put it out there, and it just didn't work. Again, the unexpected, those kind of things. Have one of those things, maybe they could survive. But with those 2 things happening so quickly without having any sort of safety net, it didn't work out. Additional rounds of financing, I did mention that before. One of the things that sometimes people don't necessarily grasp is that you can raise a certain amount of money enough to get started with whatever you want to do. And if things are working out, you can come back to market and raise money again and again and again. So it's good. You don't have to. If you look at something, Is that my time?
Yeah, they were leaving.
Okay.
They set the alarm.
That's how excited we are about your
Yes.
Yeah, oh, wow. Everyone's awake in here now, so that's good. No? So again, the additional rounds, market for shares, that's something I didn't touch on, but these, they are restricted as to what you can do with your shares. There's no market. You can't just simply buy these shares and suddenly go down the street and sell them to everybody. You have to resell them back into the fund itself or to another investor who was already in there. There's no free flowing, there's no market for them other than that. IPO and tax issues, we haven't had any CDIFs go through to an IPO. We do have one Unique Solutions that's gone through 2 venture cycles, and so it started out as a CDIF. That was the first investor, although she doesn't talk about us anymore. She now talks about the American company that came and put $25 million into the company. So, but in any case, at some point in the future, we can add that to the IPO list. And the valuation is also an interesting thing because the valuations, they're even more difficult if you're talking about the blind pools that have multiple investments in multiple companies that aren't reporting issuers. So the valuation typically for most CDIFs is it just whatever you buy them for, that's where the value stays until such time as you go about to sell them. So closing comments before the bells start to ring again. We have Unique Nova Scotia. Prince Edward Island launched, and I spent a lot of time in PEI as they were moving that forward, a Community Economic Development Fund. I think the CEDB is their acronym. I don't think they've closed their first offering yet, but they were close. Alberta, certainly with your ODCs and reaching local capital, is certainly in the same vein. And New Brunswick has been very actively engaged from their Securities Commission to ours and from bureaucrat to bureaucrat. So hopefully we'll see New Brunswick join in with the same or similar program as well. And ideally, over a period of time, the more provinces have something similar, it's certainly good to keep the money local so it can have its most benefit. Getting through the process isn't quick or easy. And you're basically going to be going out to your friends and neighbors and relatives and ask them to invest their money. And so you really want to make sure you know what you're doing before you start to do it. The CDIF program itself, the rules, the requirements, the nuances, the more you can understand, the better. We try to provide as much information as we can online, and when people have inquiries and questions, there's a lot of people who have done this that are very eager to share their expertise. And as we lastly say, the partnerships are very important in community buy-in. It's really interesting going back to the renewables again. And I've seen when people, sort of Nova Scotia Power tries to erect a wind turbine in the community, there'll be communities up in arms and they're really upset about it. But when someone sets up a CDIF and the people all invest their own money in it, and then they put up the turbine and they start cashing monthly dividend checks, it's amazing how a lot of that opposition just disappears. So with that, I hope that this provided you with some idea of what CDIFs are, how they can be useful for yourselves, and then Peter will follow me with a discussion of his experience with a particular fund. So thanks very much.
Chris, there's a couple of questions that I think people were hoping they could ask you right away, and then we can go to Peter, if Peter's okay. So I saw 2 hands over here, Carol, and then, we got several. Okay.
Hi, Chris.
Hi, Carol.
Carol Murray, I'm the Dan Kelvin's counterpart at BC Co-op Association. Thank you for this excellent presentation. It's really, really interesting and learn more than I knew before, which is great. Question for you. I'm wondering what people would see as the advantage of forming a co-op. You said 25%, and I heard the same number from Diane. Were co-ops, and the others were, I guess, the conventional business. I'm wondering what would attract people to the co-op model for CDIFs and what they see as perceived to be advantages going co-op.
It's very much, it's a personal choice as to the corporate structure, whether you use the corporation versus the co-op. But there are a lot of similarities for things like the Port of Darby co-op, and Just Us Coffee is also a co-op. So there's a lot of, there's not a single or small group of significant investors. It's more of a full community sort of investment, and it's in the sort of philosophy of co-ops, I guess, where it's the community is all doing things together versus the corporate model where some people will have large ownership positions and others will kind of tag along with smaller investments. So I don't think there's anything in particular. The co-op, you know, the one person, one vote versus one share, one vote, and there's various different tax issues from a co-op versus a corporation. But I don't think there's any real reason why a person or group would choose co-op versus corporation. It's more about what they are comfortable with. So if you happen to come from a community in Nova Scotia that has a strong co-op history, you know, that came from around the Antigonish movement and Moses Cody and those things back in the 1900s, there's just a tendency of people to look at that more, whereas for people who don't have that experience, they would tend to default back to the corporate model. Diane could obviously give a much fuller answer.
Hi, yeah, I saw, I think a Nova Scotia Haskell-Berry company on the Dragon's Den asking for money, and then I think I read that they actually got some from Zeta. Are you familiar with that? And if it is, I'll talk to you later about it. The Haskell-Berry?
Yeah, I've met with them, and I drank some Haskell juice, and it's good. It's kind of like a really thick blueberry juice kind of thing. They haven't done a CEDA yet. I don't know what they did with the Dragon's Den. I had an idea that they were going out there, but I'm not that familiar with them. So they haven't done a CEDA yet, but they certainly are they're doing some interesting things. It's a couple of British guys that were involved, but I'm not sure I can really add much to it.
Thanks.
Rob?
Yes, please. Can you just tell me a little bit about the relationship between the directors of the fund and the enterprise that's running? Kind of what the responsibility is?
Yeah, each of the funds are very different in the way they're going to run, but certainly the directors of the CEDA would need to have some way to engage with their investee corporations. So on the sort of the venture capital model, that would be one of the directors would typically sit on the board of the investee company. It depends on the investee company. Some of these are quite small and may not set up and have a board function. I think possibly that might be better to defer that one back to Peter because he's more engaged on that particular piece.
You want me to answer now?
Yeah, I'm just kind of wondering about sort of conflict of interest and how do you find directors in a small town that doesn't own the barber shop, has that thing, so it's sort of practical.
Sure. What we've done, our CEDAs have a board of directors, and we kind of have a subcommittee of the board of directors. There'll be a couple of directors that sit on the committee. Then we have the administrators, which I'm one of the administrators, and so we have the committee, and then we will meet with investee companies potentially, and then we'll make a recommendation to the board. In our community, the conflict of interest is not too big of an issue. Well, we did have a conflict, and the board director just stepped down from being a director on the company, but typically we don't have a conflict of interest.
What on the back, Luby?
What percentage of ownership would a CEDA typically take in a corporation? Would it be a smaller percentage, under 50%, or would it be a wholly owned entity of the CEDA?
It could be either. It could be anything. The CEDA, it could be an operating company happening to take place in a community, and they're seeking some investment. So a CEDA could raise capital and invest in and buy anything from 1% to 99% of the company. So there's no general rule of thumb to say a CEDA will raise and invest up to 20% of the share capital. It's truly all over the map.
You mentioned the involvement of the Securities Commission. Does that mean essentially you have to make sure that you're following government rules in order to be an entity of this type? And
Yes.
so the other question quickly would be, what's the difference? You mentioned funds and pools. What's the difference between a fund and pool?
Well, a CDIF can raise money for one particular business. So it'd be a directed fund that is directing the funds into one particular entity, whether it be a wind turbine or something else. Whereas a pool will be multiple. It's almost like a miniature version of a mutual fund.
Sure, was there one in the back? Can I see somebody put their hand up? Chris, I was hoping I could just ask you one. I was trying to remember those numbers you had. So out of so it's basically almost 60 million, right, invested in CDIPs. A rule of thumb, do you have some sense of how much of that would be RSP money? Like, is it 50% or, and because what I was trying to relate it back to was the 500 and whatever million per year that went into RSPs. Like, do you have some sense of what percentage you're currently capturing in the CDIPs?
We don't really track that other than what we find from the investment groups, such as we were talking about. And anecdotally, I think it's around half the money comes in through RSPs. So if you think cumulatively since the program started, that would be about 30 million. So in the run of a year, maybe 5 million per year, over 600 million. It's still a very, very small percentage.
Ours is about 60%.
Yeah.
With new down, it's 60% is roughly our RSP.
Yeah, good. And some of them, depending on the ones that have the larger average investment, tend to have less RSP investment.
And then, sorry, just one more question, just to try to put some of this in context. So, as you said, about 920,000 in Nova Scotia right now population. How much of that is in Greater Halifax? Because what I'm trying to figure is what's the rural population?
The economic impact of Halifax of Nova Scotia is probably something close to half. Population-wise, it's a little more than a third, so it would be maybe 350 out of 920. But the economic impact is, again, I'm kind of taking this out of the air, but it's something close to 50% of the air.
The reason I was asking that is I was just thinking of some other numbers, well, and for me, as Mike and I are having our seniors moments when we're with you guys in the vehicle, is because I know I won't remember these numbers tomorrow. Because I was doing something on Saturday, I was writing up some stuff that Paul had sent me, because on these RSPs, so I found this table, and I'm wishing now I brought for all the provinces. But in 2012, in Alberta, in 2012, that year alone, the residents of Alberta put in $5 billion into RSPs. BC, because of course we're not as rich as our Alberta neighbors, we could only put in $4 billion. And then Saskatchewan was $1.5 billion. So the numbers are really quite staggering. And then the same, I just, when I was sent some out to some colleagues around your program. So as you say, about 900,000, our population, the last figure I could get off census, we were about 3.75. And I figure Greater Vancouver, Greater Victoria is probably, what, 1.75 of that. So it just gives you the idea. It's a staggering amount of numbers that are out there. So thank you very much, Chris.